We are hoping that with the improvement of our portfolio and the improvement of our profitability, we will be able to improve our cost of equity capital and therefore put the company again on a growth mode. So I'm still hoping that by the end of this year and into next year, we will be an overnight success story 10 years in the making.
Joining me today is Luca Fabbri, President and CEO of Farmland Partners. So, Luca, can you point to an aspect of your latest earnings report that you feel especially highlights Farmland Partners' broader strategy?
Absolutely. In 2023, we engaged in a plan to fine-tune our portfolio, faced with the high cost of capital, both debt and equity that are common kind of in the whole economy and in the real estate industry in particular. And I think there are some aspects in our latest earnings report that specifically highlight the success that we had in that regard. So quarter to quarter, we reduced our portfolio by gross book value by about 12%. By the way, we were also able to reduce total operating expenses by roughly the same amount, about 12 to 13%. Yet our revenue declined only about 5%. So definitely, I would claim that as a huge success in improving the overall quality of our portfolio.
And is there a common theme or question that investors are raising with you, and how are you responding?
So these days, it feels like there are only two topics that we talk about. It's the election and interest rates. So I think that one question that we get very frequently is the impact of interest rates on the farm economy in general and farmland values in particular. I would say in brief that is much less than people expect, and certainly much less than in other parts of the economy and real estate asset classes. The reason being is that if you measure the mortgage indebtedness on a loan-to-value basis in the whole ag industry, including farmers, which are the largest class of farmland owners, is only in the teens. So leverage being that low, it means that the impact of higher interest rates on farmers' P&L is not particularly significant. So that's why that impact hasn't been very high. Farmers also being the largest buyers of farmland, and as a reflection of that first point, is that they're still buying farmland whenever they can, and therefore farmland values have remained very, very stable. Unfortunately, offering us fewer opportunities to find bargains, but this is a very efficient industry, less subject to the cyclicality of other classes of real estate, and which is also a benefit of farmland as an investment asset class.
Where do you see the greatest growth potential for Farmland Partners in the rest of this year and into 25?
We've been public now for about 10 years, and for 10 years we've been educating the market about farmland as an asset class, which is a very small investable asset class in the context of the public markets. We are hoping that with the improvement of our portfolio and the improvement of our profitability, we will be able to improve our cost of equity capital and therefore put the company again on a growth mode. So I'm still hoping that by the end of this year and into next year, we will be an overnight success story 10 years in the making.